The story on Monday will be that the S&P, the SPY, is making the death cross. The death cross. What is the death cross? And on the other side is the golden cross. The golden cross. Well, it's a theory or a strategy that says when the 50-day moving average crosses the 200-day moving average of the SPY, when it crosses it over, up, that you should buy the SPY. And when the average crosses under, at minimum, you should sell, if not go short. Now, they, whoever they is, are, that one cannot time the market. Therefore, only a fool would attempt otherwise. And what you are supposed to do, if you listen to the dogma coming from Wall Street, is to take the first 100,000 you save, and I'm just picking a number, put it into the S&P index like the SPY, and forget about it, and let it ride for 30 or 35 years. Okay, so what did we do here? That's exactly what we've done. We have the SPY on a daily. We have written or pulled up a strategy. It's right here. It's the 50 and the 200, the two-line cross. We're going to talk about the third one in a moment. I'm going to close this, and we've gone back, let me show you, 35 years. In fact, I think the SPY started trading in 1993, so it's more like 30 something. But let's say you had your first 100,000 and you put it into the SPY in 1993. Isn't that ancient history? And you're about to retire and you want to know how much you have. So we'll come and we'll take a look. And by the way, let me show you something. Let's be sure that we account for any kind of trading. We're going to say $7. 1993 it was much more than 700, but that's not anything to speak of. But we'll assume Schwab was around then at 7. And in fact, back then you couldn't even short the market, but we'll assume that you could. So let's look at a strategy performance report. So you look at this and you say, wow, not all bad. You would have total net profit if you had done that, $253,726. Much of that money would have been made on the long side, not so much on the short side. Total number of trades, 22 times. In the last 35 years has this happened. Percent profitable, 50% of the time. 80% of the time on the golden cross. Not so profitable on the short side. Confirming something that we already know, that the market does have a natural bias to the upside. When it comes to the index, the folks will cull out the losers, and we have financial media, and we have all kinds of shenanigans played to keep the index, the thought is, moving up so it attracts money. But there are periods of down. But let's come down further, and there's a lot of information here, and you can see actually the whole trading period was 25 years. So I said 35, but it's only 24 years and 10 months because one, the SPY wasn't around in 1993, and then also we have to grab about 250 days of data in the beginning to get this program to run. So we're going to say roughly 25 years. Now, a couple of things here are noteworthy. The maximum trade drawdown, or actually maximum intra-peak to valley, meaning if you kept your money in and just rode it all out, you could have had a swing of as much as 53,000, 50% of your original capital. The maximum trade drawdown, after entering, you could have entered into a trade on the long side and been down as much as 6,000, on the short side as much as 14,000. but how much have you made on an annualized basis? So we're going to say, let's do the math. Original investment. So we want to come down, and what we're looking for is the annual, find it right here. Here we are, looking for the annual rate of return. So for the last 25 some odd years, the annual rate of return following that strategy is approximately 5%. Now, when you consider this, what they don't really emphasize too much is where you start, right? Because in where you want to end, because it does need to come to an end if you want to spend any of it or live off of any of it. And what you need to understand is if you started up here and could suffer a 50% drawdown, in the next 5 years, it's possible, you would have quite a bit of catch up. If you are close to retiring in just a year or two, you might want to consider, exiting now and saying, hey, I'm not going to say it's necessarily a decent return, but I got 5% a year. But pity the poor guy that, that bought up here and gets into something, more serious. So to demonstrate that, let's just toy with the notion that, let's just say that person got in 20 years ago. And we come to the performance report, and it's $134,000 in net profit. There's a lot of other information here that's important, but what we're looking at is the annual rate of return, 4.49%. A little bit less. How about we change this to 15 years? It really is the luck of the draw as far as when you start, because again, remember, if you can't time the market, and I'm not saying you can't, of course, but they say that. So if you can't time it, then you just start when you start. When you look at the annual, let's get the annual rate again here. Let me scroll down and get that. Here it is here. The annual rate of return, 4.5%. Let's change it again. Let's just play this out a little bit. Let's mark this down to 10 years. The annual rate of return is just 2.79%. Okay, it's not like you don't have risk now. So for the last 10 years, your return has been 2.79. Your return over 25 years was 5. Is this going to get it done? How about 5 years? How did those folks fare? Annual rate of return, 1.4%. And how about, let's see if we can even do 1 year. I don't know if we would have gotten any crosses. Tell you what, we'll just do 2 years. See if we can get anything in here. And let's see if we got any kind of a report. No, because we just would have already been in the position, so we can't really calculate it from there. You would have been exiting here. So the point is, Buying and holding over the long term, if you look at the S&P index, has it been profitable over the last 30 years? Yes, it's averaged 5% a year. Depending upon where you start, it's not as though you are commanded to make 5%. And again, if you started up here or up here and you hit just fortunate enough to have a 50% drawdown, remember you have to have a 100% return just to get back to even. So when they're talking about the death cross, you know, and you've been blindly in the market, I probably would use it and you're going to be retiring inside of, 5 years. I probably would take it as a marker to get out. But how you're going to go about getting a return from there is a bigger question, and one for the next video. I'm Bag of Don at StockMarketCaddy.com. We don't make recommendations to buy or sell anything. We are a mentoring site.